Hello, my name is Marshall Easton with Financial Strength Accounting, and I just wanted to get on here today and do a quick discussion about bookkeeping, and particularly when it comes to reconciling bank accounts, why it's important, and how to do it. And I want to start off by showing an example of a balance sheet from somebody who had me do a quick look at their books. They wanted me to do some of the CFO work that I offer in my services. Unfortunately, I had to tell them I wouldn't be able to give them any reliable insights because the balance sheet that they sent me looked like this. So there's some things that popped out right away as I was looking at this. You see I marked here in yellow the different accounts here, and I changed the names of these to help make sure I keep some anonymity for my client here. So you see that this checking account right here, minus $411.22, that's actually not super odd. You can occasionally run into a checking account that has a negative value if something's been overdrawn. So sometimes, yes, that can happen. However, looking here, we see the third checking account has a minus $50,000 balance in there, which is concerning to say the least. I really hope that you wouldn't have that sort of a negative balance in your checking account. I'm pretty sure at that point the bank just might cut you off, but this is likely inaccurate, which in this particular case is inaccurate. They actually have more money than negative 50,000 in there. They're actually in the positive for that particular bank account. And then we go down the list a little bit. Here we have the uncategorized assets. Now this isn't a bank account that you would reconcile. However, as you go through the reconciliation process for your bank accounts, you're more likely to figure out what this is. And I took a deeper dive into this, and it looks like it's a bunch of account transfers and credit card payments that ended up for some reason being categorized as a uncategorized asset, bringing that to a negative $8,997 value. A general rule, you should never really have negatives in either your assets or your liabilities. With the exception of assets, you will have obviously your accumulated depreciation, which will show as a negative, and a few other things. But it's not likely you would see negatives in a checking account, and it's not likely that you would see negative uncategorized assets. You shouldn't have uncategorized assets to begin with, number one, and then it certainly shouldn't be negative. You shouldn't have negatives in your tools, machinery, and equipment unless you get to the total fixed assets, which would be zero. You shouldn't have a zero in here, but you might show a negative value for accumulated depreciation on tools, machinery, and equipment. So you shouldn't ever have negative for total assets. That just shouldn't happen. That means that somewhere in your expenses or your income or your transfers, your equity, something's not right. Your balance sheet is an important tool to use as it gives a snapshot of your business's financial position as of a specific point in time. If you're looking to get a loan, some banks are going to want to see this. They're going to see, okay, well, how liquid are you? Are you going to be able to pay this loan back if we give it to you? Or let's say you want to sell the business, or you're looking for investors. Same thing. You want to make sure that your balance sheet is accurate. And if you're not doing any of those things, it's still important for you as a business owner to have good information in here so you can make good business decisions based off of your financials. Otherwise, you might end up making a purchase that you can't actually afford, and then you're actually going to be up a creek for that. Then we come down here and we look at the liabilities. Here we have two credit card accounts here that are also negative. What this would mean if this was actually going to be true would be that means the credit card companies owe this person $32,000. I'm sure we would all love that, but credit card companies are not in the business of owing people money, so that shouldn't happen. Here we have a mortgage on here, negative $18,000. Total liabilities negative. Again, You should never see a negative value in total liabilities or total assets. It just is not possible, can't happen. Yeah, so, and then equity, of course, that is your assets equals liabilities plus equity. So here we have the total assets right there, and then here's the total equity, which brings us to the assets right here. This number should always equal what your assets is, and it does, and that's a good thing. That means the math is working, but the information here is functionally not usable. I usually go through, I do like projections, things like that. I give some insights to a client's financials using their profit and loss to do anything from break-even analysis, profitability analysis, things like that. And I just can't do it when the books are that inaccurate, because I don't know if it's also going to be inaccurate on the profit and loss statement, which is where you record your your income, your expenses. And oftentimes when I see this kind of stuff, we're going to be missing expenses. We could be missing interest expense. We could be missing income. We could be over reporting income, and you're paying taxes on money you never actually got. So it's very important to make sure you go through and you make sure your balance sheet is up to date, and you do that by going through and doing reconciliations. So how do you do that? So if you're using QuickBooks, this is the sample company that QuickBooks provides. So this is a fake account. This isn't one of my clients or anything like that. So this is the sample company. So in order to do a bank reconciliation, I want to also add real quick, QuickBooks just changed their user interface. So the pathing you're going to see me do is going to be different. It's not going to look like this. It's going to change, but the methods are going to be more or less the same. In the new section, in the new UI, this looks different. It's going to have like a little square with 9 blocks in it for apps. You click on that, you'll go to banking, and then that'll open up another menu where you will see reconciliations. So here in your bank feeds, you can open up that, and looks like I'm having some issues with connecting at the moment. Give me just one moment, and I will be right back once this is working. Okay, all right, I am back. So now that I got everything working again, let's get back to it. So like I was saying, this UI is going to be different, and also I am an accountant, so my view is also going to be a little different. I'm going to have some things on here that you might not have, but the general layout, what we're going to show you coming up next, is what you're going to see. But like I said, you're going to go to the little dots to banking, and then you're going to choose on reconcile. So let's go in here to reconcile. And so I've already started this, but typically what you'll end up doing is you're going to right here, I'll switch over to this one. So in here, you'll see what the beginning balance was. So you're going to want to check your bank statement from this month, or your most recent bank statement. Make sure that the beginning balance matches. If it does not, for something got deleted, you'll usually see some sort of warning saying, warning, something's been deleted, your beginning balance is incorrect. So you want to go and get that fixed. But then what you'll do is you'll look at the statement ending balance, you'll type that in. So $2,000, and then we'll say, August 31st, 2025. Okay, so you put that in, you'll hit start reconciling. So I'm working on this one here. We're going to do resume reconciling, but I've actually already got it pulled up over here. So I'm just going to switch tabs. Okay, so this is what we're looking at. So when you go into this screen, this is the reconciliations page. You're going to see what the statement end balance was, what the cleared balance was, what the beginning balance was, how many payments you made, how many deposits there were, and how much that total was. Most bank statements will tell you how much was debited to the account and how much was credited to the account. Now, I want you to keep in mind when you're looking at a bank statement versus doing your own books, the bank is going to show deposits into your account as credits, and it's going to show withdrawals from your account as debits. In your accounting, you will record deposits as debits and payments as credits. The reason why the bank shows it the reverse is because you are actually an accounts payable to them. So whenever you take money out, they are going to credit that account of their accounts payable, and then they're going to debit that account whenever you have a withdrawal. They're going to debit it. Whenever you deposit, they're going to credit it, because to them you're accounts payable, and you credit accounts payables to make the number go up. I digress. So it looks right here, when we want to see a $0 difference, green, finish now, hooray! But I want to show you why this particular client's balance sheet might have looked as bad as it does. Now again, this is just the sample company, so some things are going to be a little bit different. Let's just say and pretend that all the ones that are already check marked right here all have these little green double boxes here. What that means is that this transaction was actually brought in through the bank feeds, and it was classified using this screen on your QuickBooks account. That means you've gone in here, you've matched what you needed to match, you've categorized what you needed to categorize, and all that goodness, and that's going to actually bring it into the reconciliations page. It's going to automatically check mark it for you. It's going to have these double green boxes here. That just means that it's already been matched to a bank transaction from the bank transactions feed. Okay, we're going to pretend all the ones that are check marked here were already brought in through the bank feeds. Because this is a sample account, I'm very limited on what I can show you. But the reason why I want to have that make believe that these are all through the bank feeds, because if you notice, we've got two transactions here that are not check marked. Okay, now they have been recorded, and they are going to show up in the chart of accounts register for that account. When you open up your balance sheet, you're going to see what these are doing to the balance of that. If you don't check mark it and then you just hit finish now, it does not remove these in any sort of way. They're just not reconciled. So that is where you're going to come up with a lot of those problems. So let's take a look at these two here that are not pre-check marked. So let's look at this first one here. We have received payment, accounts receivable, Amy's Bird Sanctuary, Amy claims the pest control did not occur. That's just a little note that the scenario gives us. It's not very important to what we're discussing right now. But what we're seeing here is the person who is running this account received a payment from Amy's Bird Sanctuary, either through a check or Amy paid the invoice with a debit or credit card. One way or the other, that got recorded. Either they went and recorded it manually by going into invoices, customers receive payments, or here, and they do receive payment, anything like that, and they manually put that in. Okay, and then when they were in the bank transactions, they saw a deposit of $105, but rather than matching it, they categorized it, and they put the name, they put Amy's Bird Sanctuary, and then they did landscaping income. So they went in here, they did that, and they hit add. Okay, they didn't see how we have one match found, and then we have a match right here. They didn't hit match. Okay, I actually had to invent that scenario because it doesn't automatically happen within the sample company. But regardless, this is something that I see that happens all the time with people who run their own business, but also run their own books rather than having someone else do it for them. And even some bookkeepers will mess this up because becoming a bookkeeper is very easy. All you have to do is be 14, your parents run a restaurant and they don't want to do it, so suddenly you're the bookkeeper. That's how easy it is to become a bookkeeper. So every bookkeeper is going to be different. I happen to have a bachelor's degree. I'm a certified QuickBooks Pro Advisor. So I've gone through some certifications. I have a degree. So when you are interviewing people to be a bookkeeper, probably some good questions to ask is what is their background in bookkeeping, what's their education, things like that. Because you don't want someone to come in and mess up your books while you're also paying them. It's bad enough when you're doing it yourself for free. So what's going to happen here is we're seeing two different transactions for the same person on the same day going into a revenue account. So what does that mean for you, or for this client that we're working with? That means on his profit and loss statement, he's actually reporting an extra $105 that he did not actually receive, and he is going to pay taxes on that. That's why when you are doing your books, you do not want your balance sheet to be incorrect like this. You want this to all match. You don't just go into the reconciliation page, see this, and hit finish now. You got to go through and you got to clear this out. So then what you would want to do is you actually want to go here, edit this, delete it, get it out. It is, and notice how I deleted not the received payment. We want that. That is actually tied to the client. It is going to show that the client paid their bill. That way, when you look at your customer's review page, you're not going to show Amy as having an open balance. By deleting it out of here, what it will do is it will actually send it back to the bank transactions where you can then match it. I had to manually put in that deposit so I could show it in here, so it's not going to come into the bank feeds because it didn't come through the bank feeds. But we're going to pretend like it did. And so it comes back in here, and you're going to want to match it to that received payment. Okay, don't match it to an invoice. Match it to a received payment is what you want to do. There we go. Match payment. You want to match it to a payment, not an invoice, because if you match it to an invoice, it's going to record another payment, and now that client is going to have a credit on their account, which means that next time they have to pay you, they're not going to actually have to pay you because you recorded a credit on their account. Okay. All right, look, yay, we're back at zero again. Now we deleted that. We were at $105 difference, but now we're back. But look, we got one more down here. This is the other common one. Here we see transfer to savings. Transfer to savings. We see it twice. One of them magically came in through we're pretending came in through the bank feeds. Just imagine it's got the double squares there, and it automatically got checked. But here's this one. I'll tell you what happened here. In the bank transactions, again, I had to put these in manually to show you. In the bank transactions, you'll see a money spent here, $200, and then you'll see in the bank detail, it'll say transfer to such and such bank account with the last four numbers, usually, depending on what bank you have. Sometimes it's very easy to tell what bank it went to, other times not, but you'll see that in here, and again, you're going to want to match one of them. So you'll come in here, or it'll say paired to another account, another transaction, and you'll want to make sure that it matches, because it'll show up as a money spent here, and then it'll come over here and it'll show as a money received here. So if you record it separately, you go to categorize or record as transfer without matching it, it's going to show up twice in here, which means that when you look at your balance sheet, it's going to show you have $200 less in that account than you actually do. So what do? Again, we go to one of these. If I can get come on, scroll down. Yeah, there we go. Okay. What in the world? We'll do this one. All right, so you'll go to one of these. We're going to delete it out. Delete the transaction. It's gone. We haven't reconciled it, so that's fine. It's going to send it again back to bank transactions, and this time you're going to hit the match button. Okay, that'll match it. Then that way it's not being double counted. Then you come in here, select that. Now we have the $0 difference. There's nothing in this that is unchecked. We hit finish now. And that's how you do it. That is how you do a reconciliation the correct way in order to make sure that your balance sheet is correct, so that way you can actually make good, useful decisions based on your financial data. Again, my name is Marshall with Financial Strength Accounting, and if you would like any help with your books, or if you would like someone just to take a look at it and see if you've been doing it right, take a look at my website at www.fsabookkeeping.com, or look me up on Facebook, and looking forward to showing you guys some more tips and tricks in the future. Have a great day.